Market orders. This video is all about market orders. How much are market orders costing you per year in trading fees and in potential other fees? That's what I want to talk to you about here in this video. The reason I'm making this video is because I have a lot of people that often come to ask me for advice through emails and through my remote assistance service. And I see the way they trade, and I see that beginner traders often tend to gravitate towards the usage of market orders for trade entries and exits. Just a quick rundown. A market order is basically an instruction to your broker to fill your buy or sell order for a stock or an option or futures contract at the best available price. But actually, in reality, it's technically the worst available price. I mean, if you're just practicing a couple of shares at a time, a market order is not going to kill your account. But when you start trading larger sizes, it's very important that you optimize your order entries to use limit orders or other orders that can save on trade commission fees and potentially result in price improvement. If you have a lot of shares to buy, you're not just going to buy them from the best offer. You're going to submit a few bids down below, and you're going to give yourself some room for the market to come down and fill your big order. That's how big traders think. They don't just go in and pay whatever the market price is. They analyze the market using their proprietary techniques, and they determine what their trade price is going to be. And sometimes they might have to pay a high price for it because it's part of the strategy to do that. And then, of course, the number one thing you need to consider, depending on if it's a really fast trading strategy or not, is the overall profit after trade fees relative to the market volatility and how much you're expecting to make on the trade to begin with. Now, on the IBKR website, they actually put a pretty useful sentence here, which they said, overall, market orders may be useful to investors when markets are liquid and their order size is unlikely to move the share price. However, if markets are less liquid, this order type could move prices adversely, especially for larger orders. And the reason why they say that is because when you submit a market order to an exchange, the exchange market makers see those market orders, and it's at their discretion to fill them at whatever price they can fill them at. They may decide that it's not worth filling the market order at the price where they're currently offered. So they're going to, in a split second, in a microsecond, move their offer away. And then it's at the discretion of those market makers to fill the orders at whatever prices they can fill them at. If there's a lot of volume and liquidity in the market, then you'll get a better price, obviously. But if you're trying to trade a remote stock, go in there and submit a market order or an option contract, there's a good chance you're going to get a bad price. And a bad price is relative to the current price and where it's been trading right now. Now, all of this can be solved if you simply submit what's called a limit order. A limit order is an order where you actually select the price of where you want to bid or where you want to offer. This is the typical way of doing business in any industry, not just trading. So it boggles my mind when I see investors coming in here and saying, I just want to trade on market just because it's faster and I want to be filled right now. Because the whole point of trading is most of the time buy low, sell high, or buy high, sell high. The thing is that when you use a market order, you're instantly giving away a little bit of your profit every single time. And depending on the bid offer spread, which I'm going to get into a little bit more in the video here, traders could be giving away up to 10 to 20% of their initial profit on the trade simply by using a market order. And obviously there's a few other things here that I use to reduce the trade commission fees, but I just want to show you some examples. So first at the top here, these two orders were executed using pure market orders. So buy market, 10 SPY put option contracts, and then sell market, 10 SPY put option contracts. I paid a total of $7 US each time. So that would be a total of $14 US. Now, when I used the limit order and I routed to the exchange that was offering a rebate, and I also set my limit order to post only, my trade commission fee was reduced significantly for the same 10 contracts on the same exact put option contract. You can see here I bought 10 and I was charged a commission of $2.15, and then I sold 10 and my commission is $2.22. I'm going to show you how to do this, but you can see, guys, that the trade commission difference is 200% different. In fact, it's a little bit more, but I'm just kind of spitting out a number there. The same goes for stocks. When I entered with a market order, in this case, I was charged 67 cents. When I sold with a market order, in this case, I was charged $2.38. Now, I did another test with a limit order and I had the same result. But when I selected the Smart Max Rebate routing option on Interactive Brokers, my entry trade commission was reduced to 8 cents for a 100 share buy, and my exit trade commission was reduced to $1.79 for a 100 share sell. So you can see that just by using some of the techniques that I'm going to show you here, you will be able to reduce your trade commission by sometimes upwards of 200%. And if you're trading hundreds, thousands of shares every month, every year, this is going to add up to be a lot of money. Futures are a type of contract that have a fixed trade commission fee. So whether you use a market order, a limit order, the trade commission is always the same. That's an advantage that futures have. There's still one thing that you're forgetting, is that when you place a market order, you're paying the asking price and you're paying the bid price if you're selling. Now, when I talk about the spread, since I'm on the topic of the spread, I want to give you guys an analogy here. So let's say you're scrolling Facebook Marketplace and you're looking at what people are selling a certain car at. Let's say someone is selling a car for $10,000. That is their initial asking price. Now, if you go in and you say, I will pay your $10,000, you're essentially submitting a market order to that advertisement. You're saying, I'm willing to accept your offer of $10,000, give you the $10,000 and take the car. Now, depending on the market for that particular car, the seller may or may not be willing to adjust their offering price based on certain bids that other investors make on their car. So if someone comes in and says, I'll give you $8,000 for the car, the person selling the car might say, you know what, that's a pretty good offer, but I'm only willing to let it go for about $8,500 is my lowest price. Just by negotiating with the person selling that car, you were able to save $1,500 right there, just by bidding. When you bid and you said, I'll give you $8,000 for it, what you're essentially doing is you're submitting a limit order to that trader selling the car. You're saying to that person, I'm willing to give you $8,000 for the car. It's a limit order for $8,000 when their initial offer was at $10,000. And this is how the stock markets and options markets work all day long. There's bids and offers. And the difference between a stock market and a car market is that you can actually physically see the number of transactions going through on both the bid and the offer all day long. There is a solution to this to get the fast fills that you want, get filled right now, but also use a limit order and take advantage of some of the things that I've been talking about here. Now, back to our example of earlier. Now, let's say that person is selling the car for $10,000. They only have that one car to sell. Depending on how rare that car is or what the market looks like for that car or how many bids they're getting for their car, they will be more or less likely to want to move their offering price. For example, somebody that really needs to sell now would be willing to negotiate their price down, maybe down to $9,000 or $8,000 from their initial offering price of $10,000. Whereas somebody who is not in a rush to sell and they know very well that the asset that they have, the car, is a rare car, they're not going to budge when it comes to their offering price. They're going to sit there. Now, if it's a really rare car, people might even overbid their offer, which is obviously not something that occurs in the stock market. Normally, when there's an offer, people, if they want to buy now, they go in and pay the offer. And then once there's no more offer, then it goes to the next offer. And then if someone wants to buy right now, they have to buy at the next offer. Now, if you look at a market, let's say Meta stock, for example. If I look at the bid, the current best bid in Meta is $702 even. And the current best asking price is $702.20. There's a 20-cent spread between the bid and offer. That means that if you pay the offering price, you have to pay 20 cents more than if you pay the bid price. And that also means that if you use a market order, you're paying the asking price to buy. And when you sell it, you're going to sell on the bid with a market order. Now, the problem people have when they think about limit orders is they think, well, if I use a limit order, it doesn't guarantee a fill. I want to get in right now. But you have to understand that whenever you're negotiating for an item, there's never a guarantee that you're going to get that item. And if you want to get the item, you're always going to have to pay the offering price that the person's offering. And most of the time, that price is too high. And you could save if you wait for sometimes just a few seconds. How do you determine what price to put your limit order at? Here's a good strategy. First thing is, look at the bid then look at the ask, then look at the time and sales. If you're in Trader Workstation or another software, they most of the time have a window called time and sales. You can see every transaction going through on the exchanges, and you can see at what prices the stock is currently trading at relative to the bid offer spread. So you can see right now we're seeing a lot of volume at, say, 702.40, 702.30. We're seeing some prints at 50. So what I'm looking at here is I'm looking at the prints that are taking place on the offer, which are green, and then the prints taking place on the bid, which are red. If there's enough prints taking place on both the bid and the offer, it means that if you submit an order somewhere near the bid, or maybe a few ticks above the bid, there's a good chance that you will get filled. But you need volume going through in the market for this to happen. If this stock was dead and we're trading, only a couple of shares every minute or every 30 seconds, it's going to be very difficult to get filled on the bid because you're going to have to wait for an order to come in to fill against your bid. And the market makers always get priority. So if you're just a retail customer, you're going to be last in line and you probably will not get filled. However, if you're trading a stock that has a lot of volume like this one, if you went in and you bid for 701.80, 701.75 and you followed the bid price, and even if you went a bit below the bid price, depending on what you think the stock is currently doing, there's a good chance that you're going to get filled because there's enough volume on both the bid and the offer. And that's why when you're trading a high volume stock or a high volume option, you should almost always, without exception, be placing your order somewhere in between the bid offer spread. Traders who are more patient are going to place their order on the bid or below the bid because they're bidding for a certain price and are waiting for their price to be achieved. And more aggressive traders will be willing to trade maybe on the offer or right before the offer. And when they're doing that, they're improving upon the best bid price and they're trading somewhere in between the spread. This is the way professional traders think. It doesn't matter if you are swing trading, investing, or day trading. Obviously, all of those things are going to ultimately impact how aggressive or not aggressive you are on your orders. For example, someone who is a market maker, they have reasons for why they need to bid and offer at certain prices, and they can't really budge from those prices. Those are the prices they make. When you go and exchange, let's say US dollars for euros at a currency exchange bureau or online using a service, you're paying whatever the spread is that your provider is giving you. They're taking a small cut because they need to operate their business. Now, these are some things that matter when it comes to if you're going to decide to use a market order or a limit order. The first thing, of course, is what kind of asset are you trading? If you trade futures, as I mentioned earlier, there's no trade commission fee difference whether you use a market order or a limit order or any other order. The trade commission always stays the same. When you trade stocks or options, the trade commission can vary quite a lot, as I showed earlier, sometimes upwards of a 200% difference in a trade fee, depending on the broker and the agreement you have with the broker and all that. There's more fees for when you take liquidity as opposed to when you provide liquidity. And there are ways of providing liquidity and getting filled fast, which I'm going to show you how to do at the end of the video if you stick around. Other things that you really need to consider when it comes to whether you use a market order or a limit order is your trading time frame. How big is the target from your original entry? Because depending on how much commission you're paying, you're already giving away a percentage of that profit. And if you pay the offer to get in, you're giving away even more of a percentage of your profit, depending on how much each tick is worth in the market and how big the bid offer spread is in the market. If you trade SPY stock, you can see the bid offer spread in this case is 3 cents wide. Sometimes it's 2 cents wide, sometimes it's 1 cent wide. Look at the bid and look at the offer. They're only about 2 cents away from one another, meaning that if you use a market order and you market buy, you're only giving away about 2 to 3 cents per share. Whereas if you did that on Tesla stock or Meta stock, you'd be giving away more. In this case, the spread on Meta stock is 31 cents right now. So if you'd be paying 701.60, you're giving away 31 cents per share times 100, that's $31. And depending on how far away your profit target is from your original entry price, that $31 could be a significant portion of the profit you may have earned on the trade, depending on if you're scalping or going for a bigger intraday position trade. And because you paid the offer to get in, you got charged more and it took away, that $31 out of your account. Whereas if you would have just traded on the bid, you could have improved your pricing a little bit. And this type of thing repeated over and over and over again, if you're an active trader, is going to make a big impact. That's why trade frequency is also a very important determining factor. But one thing that's so important is the bid offer spread, because if you use a market order in a market like Metastock, or even in an option contract, there's a good chance you're giving away 20 to 30 cents every time you trade. Like, look at these options, for example. I'm looking at Meta calls expiring today. There's about a 20-cent spread right there, which would be, if you pay the offer, you're giving away $20 right away. How do you determine where to place your order? I know it's a lot of work to think about this stuff, but you need to think like a professional. Professional traders know what prices they're willing to trade around. Sometimes they're more flexible. Sometimes they're more fixed. They're not going to be willing to accept a worse price than that. So if I look at, for example, these, let's say this one, the 700 call, look at the volume going through in the 700 call. You can see right now we're 12:10 and there hasn't been any volume since 12:09 and 40 seconds. So not only is it dangerous to trade this because there's not enough volume, it's also dangerous to trade it because there's about a 20-cent bid offer spread right there. So if you went in and you bought the ask with a market order, good luck trying to sell on a limit order unless you're very patient, because if you want to sell right now, you're going to have to pay 20 cents to get out. And the reason why you're going to have to pay the bid to get out is because there's not enough volume going through on both the bid and the offer at the same time, which can be problematic and you can result in getting stuck in a trade. Here's a few solutions to getting around this. The first one is using a marketable limit order. What's a marketable limit order? So if I go into this SPY market over here and I submit a buy order like that for 100 shares, I'm going to click on this box. You can see the current bid is 608.90. The current offer is 608.93. If I submit a buy order at any price higher than the offer, that is essentially a marketable order, a marketable limit order, because I'm submitting a buy order higher than the best offering price, which means that when my order gets transmitted, it's going to transact with the trader that's on the offer, because that's already the best offer. There's somebody in the market saying, I want to sell at 608.79. That's the best ask or the best offer. So even if I submit an order all the way up at 609, it's still going to trade with the best offer. So that's what's called a marketable limit order. Now, actually, most of the time, when you submit a marketable limit order, it's still going to be subject to taking liquidity fees on cryptocurrency exchanges and on stocks and options exchanges like Interactive Brokers. Now, there's ways around this. There's a feature called post only. You can research it. You click on the limit price box of your order and you can see there's a feature called post only there. What this does, it essentially makes it so your order will never take liquidity from the market, and it will always wait for a counterparty order to come in and be matched with your order. Could be a market maker or could be another retail investor. And when your order is matched with that order, that's when you trade, and you do not get charged liquidity taking fees. Some cryptocurrency exchanges also have this feature built in directly to their order entry panel. You can see it's right here in Interactive Brokers. Now, if you combine this feature with a marketable limit price, you're going to get the best of both worlds. You're going to get the fastest fill possible, and you're going to get filled somewhere near the ask, and you're going to pay lower trade commission fees. Now, for a trader who wants to be aggressive, get into the market now, but also save on trade commissions, sometimes upwards of 100 to 200% when they're trading stocks or options, they're going to use post only combined with a marketable limit order, which is essentially going to aim to get them filled on the ask, but not pay liquidity taking fees. So let's say I do that right now. Let's say I go into the SPY market and I do post only enabled. So now you can see if I go to my limit price, you can see post only box is checked. And you can enable that as a default in order presets. And then you go to your limit price, submit it at a price above the offer. Let's say I submit it at 609 and it's filled immediately. And by the way, this is a demo account. So even if I submitted a limit order, I submitted it above the ask, which means it was a marketable limit order. And I had post only enabled, which means only fill my order when it's matched with another order. So I guess what happened was I got matched with the order on the offer and now I'm filled. So if I look at the trade price, you can see I paid 21 cents for a 100 share buy on SPY using post only and a marketable limit order buying on the ask. Okay, now let's do the same for a sell. Now I'll come over here, I'll click here, and I'll use a button on the buttons panel to click sell. I'll do 100 shares. I'll enable post only. And I want to submit a marketable sell limit order. So what that means is I have to put my limit price below the best bid price, or at the best bid price, but below is better because the bid ask price moves around a lot. So it's good to give yourself a bit of an offset away. So the best bid is 608.80. So if I come in and do 608.70 and then transmit it fast, I'm filled. I sold at 608.80. And then I'll look at the trade commission and you can see I paid $1.92 for that. So that's how you get in and out fast and lower your trade commission fees. Now, there's another thing if you're using interactive brokers. By the way, if you guys appreciate this content, consider supporting the channel by clicking on the link down below and checking out interactive brokers. I recommend this broker for trading US stocks and options. I've used them since 2019 myself. I would say they're a very good all-around broker. They have many different assets you can trade. I tend to invest in US treasuries with them in my personal accounts. I don't give any investment advice, but one thing that I would say about interactive brokers is that they're not so good for borrowing hard to borrow stocks. If you do a lot of small cap shorting, they may not be the best broker for that. But if you do options trading on US stocks and the big name stocks, or even shorting big name stocks, they're perfectly fine for that. And the trade commissions are low, as I'm showing here in the video. So there's a feature that interactive brokers offers called the ability to choose your routing options. Now, they have smart routing, which is essentially an algorithm that automatically determines which stock exchange venue to route your order to. However, they have even more sophisticated ones that can target it towards the highest volume exchange with the highest rebate, or even the one with the highest rebate totally. And the way you check that is, let's say you submit an order. In the order ticket or in the quote monitor like I have here, there's a panel called destination where you can see where your order is being routed to. In this case, it's just using regular smart routing. But there's different routing options. So if I click over here on the routing options, you can see I have Smart Max Rebate, I have Smart Prefer Rebate, I have a Smart Highest Volume Exchange with a rebate. If you do Smart Max Rebate, it may take a little longer for your order to fill, but you will get a lower trade commission fee. So it's up to you to determine what you're willing to accept. If you need the fill right now, I would recommend going to the highest volume exchange with a rebate, because since you're selecting highest volume exchange, it means there's the most amount of volume going through on both the bid and the offer. So if you submit your order in between the spread or even on the bid for a buy, good chance you get the fill. Obviously, it depends on market conditions and how much volume is going through right now. The fill speed is not going to be the same if you submit it right on the market open compared to if you submit it at noon Eastern time, because the market volatility conditions will be different. Right on the open, there's a lot more volume. And you can set that as a default in the settings. You go to File, Global Configuration, and then you go all the way down to Orders, and then you select Smart Routing. And then you see the routing options for both stocks and options. For stocks, you can see by default, they give you regular smart, but there's also options for Smart Max Rebate, Prefer Rebate, etc. And the one that I was talking about earlier is highest volume exchange with rebate. That's right there. So if you enable those, you'll get a balance between fast fill price and lower trade fees. The same goes for options. Try this yourself on the demo account, guys. If you combine Smart Max Rebate or Prefer Rebate with post-only limit orders, and that's how you get the commission fee reductions that I displayed earlier in the video. How do you enable post-only? I'm going to show it even though I showed it in other videos. It's very easy. You go to your order presets, okay? Select the asset class you're going to be trading, let's say stocks. You have to select at the top all possible fields, or else you don't see post-only. Select all possible fields. Then you scroll down until miscellaneous. And this is where you'll see post only as an option. Now, when it comes to selecting which order routing destination gets selected as the default, that's done in the other settings window I showed earlier, which is under Global Configuration, Orders, Smart Routing. And then this is where you can set the default option. So for options, I have Smart Max Rebate. And honestly, I never had really slow fills, even just using Smart Max Rebate. Although if you do start trading more remotely traded contracts, it's possible that you can experience some issues filling your order using that. Try it for yourself, guys. I hope you enjoyed today's video. Make sure to click into this playlist right here to learn about all the other tutorials I have on interactive broker software. And make sure to click into this video right here if you want to learn about some of the custom studies that I write for Sierra Chart. I'll see you guys in the next video. Take care.